Hi, I'm Justin Pritchard. This is a short video about planning for retirement, specifically figuring out how much income you might need in retirement. And with that number, you can put it into your retirement calculator, or you can talk with your financial planner and figure out what it's going to take to give you the income you want in retirement. We'll cover 3 ways to arrive at that number, but before we get into the details and the numbers, it's important to pause and remember that this is not just a numbers exercise. It's also sort of a philosophical exercise or an emotional exercise, because what you're doing is kind of predicting your future and really envisioning the future that you want. So these are important questions like, what do you want your retirement to be like? What will you do with all that time? Where would you like to be? Who would you like to be near or with? And what's important to those people? So I'd encourage you to ignore the numbers for just a minute and take a moment to appreciate that this is really something you can figure out with your loved ones and envision the future that you really want for yourself. Now, once you're ready to get into the numbers, we'll talk about those 3 approaches to figuring out your retirement income. The first one is what's called a replacement ratio. And with that strategy, you replace a portion of your current income. Most retirement researchers use 70 to 85% as a replacement ratio. So, for example, the number 100 is easy to work with. Let's assume you have $100,000 of current income. If you replace 70%, then we would be aiming for a $70,000 income in retirement. We'll adjust it for inflation later. If you replace 85%, then we would look for $85,000 of income in retirement. Now, you might ask, why would I replace less than 100% of my current income? Wouldn't it be nice to have at least as much, if not more? And the answer is yes, it would be nice, and you certainly can try to replace 100% or give yourself a raise in retirement, but it's difficult to do so. It makes it a lot harder to save the money you need, which might mean that you have to work longer. You might need to save a lot more each year going forward, and ultimately it might turn out that you don't need that much in retirement. For example, you might have all of your debts paid off, your mortgage and any car loans, student loans are behind you. You're not paying payroll taxes anymore once you stop working. The kids might be gone, so you're no longer supporting them. Some of your expenses will change, and to be sure, some expenses will increase, especially, for example, healthcare, and we'll talk about that a little bit later. The second approach is to use a retirement budget. So that's to list out all of your expenses that you think you'll have in retirement. And of course, it takes some predicting the future, and you can base those numbers off of how you spend money today. That's a reasonable way to start, and certainly some things will change. But we have good information today, such as, how often do you like to eat out? Do you go on vacation often? And what are the types of expenses you pay for those vacations? How much do you spend on food? Do you buy new clothes or have expensive hobbies or inexpensive hobbies? You might just need a pair of hiking boots, or you might need something expensive. To use that method, go through your spending today and figure out how much you spend on common things. Then go back and look at all of those annual expenses that might slip through the cracks. We don't want to forget about those. Those might be your property taxes, life insurance premiums that you pay annually, things like that that aren't going to show up on a monthly statement. And again, for retirement, we'll adjust those numbers for inflation. Finally, if the other 2 methods don't seem to work for you, you can use a lifestyle range as the third approach to figuring out the income you need in retirement. And to use that strategy, what you do is you pick a number that would be an annual income that would let you get everything you need to be happy. So you might have some idea what that number is. It might be $50,000, or it might be $150,000, or whatever it is for you. If you have some idea of what that is, we can use that as a target for your retirement income. Now keep in mind, of course, that the higher you go, the more difficult it is to reach that goal. You need to save a lot more, which might mean working more years. It might mean making bigger sacrifices today. And again, we want to make an educated guess and not, make you work too long. What about inflation? Historically, prices have gone up over time, and it's reasonable to assume that that would keep on happening. Now, you might not retire for another, 20, 25 plus years, or even if you retire tomorrow, ideally you're going to stay retired and paying yourself income out of your assets for the next 20, 30 plus years. So over those long periods of time, prices can certainly rise. We want to be prepared for those rising prices so that it doesn't erode your standard of living or eat at your purchasing power. And fortunately, most retirement calculators handle all of that for you. You put your current income or your replacement ratio or whatever it is into that retirement calculator or that financial planning software, and it's going to adjust for inflation for you. The important thing is to know what assumptions the calculator uses. So what's the inflation rate that it's going to assume, and is it also going to adjust your Social Security? Is it also going to adjust the amount that you're putting into your retirement accounts with inflation over the years? Whether it does that or not, it's just important to know what the calculator does. We'll talk more about those assumptions, including inflation rates, at a different time. What about healthcare? So healthcare is a big expense, especially in retirement. It's difficult to predict because it has to do with your health and your body and what's that going to do. Plus, the landscape has been changing quite a bit recently. Well, there are a couple of ways to deal with healthcare. One is to earmark some assets for healthcare. There are several studies that come out each year that estimate how much retirees are going to need for healthcare, and that covers their Medicare premiums, out-of-pocket costs, medical and dental. Might and might not include long-term care, so you want to know whether it does or doesn't. But either way, you earmark assets for retirement. Another approach is to pick an annual amount to budget for each year in retirement that you're going to spend on healthcare. And you can get those estimates, again, from a lot of the studies that are coming out. All have up-to-date information on the website, but it probably doesn't make sense to put it in a video because it might get stale over the next year or something. For now, let's just say that Medicare does not cover everything. It does cover quite a bit. You might not have huge healthcare expenses if you're fortunate, but you might have healthcare expenses. So for now, let's just say you want to earmark that, and we want to pay attention to it as you build a plan. Now that you have a couple of strategies for figuring out your income, you know what to put into your calculator, let's recognize that we're predicting the future here. It's going to be hard to get it perfectly right the first time, but the important thing is to get started and do something, right? So to get you going in the right direction, and then over time, gonna make some adjustments as new information comes around. As your life unfolds, things are almost certainly going to change. So we get you started in the right direction with these numbers. Then you can figure out what adjustments to make, and hopefully it's just little tweaks. If we're doing a good job of planning and maintaining the plan and checking in periodically, hopefully you can just make little tweaks over time and it's nothing too painful. So anyway, I hope that was helpful. Thank you for watching, and we'll see you again soon.